Ever wondered why the stock market in 2020 behaved like a roller coaster ride? Let's take a moment to dissect this enigma. The year 2020 was a whirlwind for the stock market, with unprecedented levels of volatility. It was a year that seemed to turn the rules of the game on their head, leaving even seasoned traders scratching theirs in confusion. At the heart of this volatility was the global pandemic, a health crisis of a scale we hadn't seen in a century. The virus sparked fear and uncertainty across the globe, and the stock market was no exception. As businesses shuttered, economies went into lockdown, and consumers hunkered down at home, the market took a nosedive. But the pandemic was just one piece of the puzzle. The year 2020 was also marked by economic uncertainty and global tensions. Trade wars, geopolitical conflicts, and the US presidential election all contributed to a climate of unpredictability. The market, being a reflection of the world, responded in kind. Prices swung wildly, with steep drops and soaring gains often happening within the span of a single day. What does all this mean for you as a trader? First and foremost, it underscores the importance of being prepared for volatility. The stock market is not a predictable beast. It's influenced by a multitude of factors, many of which are out of our control. But by understanding these factors and how they impact the market, you can better navigate the tumultuous waters. Second, it highlights the importance of resilience. In a year like 2020, it was easy to panic and make rash decisions. But those who stayed the course, who remained steadfast amidst the chaos, were often the ones who came out on top. Lastly, it serves as a reminder that the stock market is not a get-rich-quick scheme. It requires patience, knowledge, and a dash of courage. Understanding the stock market isn't about predicting the future, but about being prepared for every possibility. Did you know that information, or the lack thereof, can make or break your investment? Information is the lifeblood of the stock market. Its power is immeasurable, and the right piece of data at the right time can be the difference between a successful investment and a financial loss. In 2020, for instance, the global pandemic sent shockwaves through the economy. Those who had timely and accurate information about the impact of the virus on various industries were able to make informed decisions. They sold stocks in industries likely to be hit hard, like travel and hospitality, and invested in sectors that were set to thrive, such as technology and healthcare. However, it's not just about having information, it's also about understanding it. Information can be a treasure trove of insights or an overwhelming flood of data, depending on how you approach it. So, equip yourself with knowledge and learn to decipher the signals amidst the noise. Remember, in the world of stocks, information is gold. Ever thought about how your emotions can affect your investments? Well, they can, and they do. Emotions such as fear and greed can play a huge role in your investment decisions. When the market is on a roll, greed can lead you to buy more than you should. Conversely, when the market dips, fear can make you sell off your investments prematurely. The year 2020 was a prime example of volatile markets. Many investors got caught up in the frenzy, allowing their emotions to guide their decisions, often to their detriment. It's crucial to maintain a level head in these situations. Being rational and objective can help you navigate through the market's ups and downs more effectively. So, how can you keep your emotions in check? By sticking to your investment strategy, regardless of market conditions. Remember, investment is not about winning every time, it's about making steady progress over time. Don't let your emotions dictate your investment strategy. Ever put all your eggs in one basket and regretted it? Well, in the realm of investing, that's a gamble you don't want to take. So let's talk about diversification. It's a term that gets thrown around a lot, but what exactly does it mean? Think of diversification as a sort of insurance for your portfolio. It's the practice of spreading your investments around in order to manage risk. Instead of putting all your money into one stock, for example, you'd invest in a variety of stocks across different sectors. You could also include other asset classes like bonds, real estate, or commodities. The idea is that if one investment doesn't perform well, others in your portfolio might do better, offsetting the loss. Now, why is this important? Let's take a look back at 2020. It was a year filled with unpredictability. Some sectors like technology and healthcare soared as the world adapted to the new normal. but others, like travel and hospitality, took a heavy hit. If you had all your money in the latter, you'd have felt the pain. But if you were diversified, the blow would have been softened. Think about this. If you were only invested in airlines when the industry crashed, so would your portfolio. But if you had also invested in tech companies that benefited from the stay-at-home orders, those gains could have helped balance out your losses. Diversification doesn't guarantee that you won't lose money or that you'll make more of it, but it can give you a safety net, a buffer against the volatility and unpredictability of the market. And in a year like 2020, that could make all the difference. Of course, diversification isn't a one-size-fits-all strategy. It depends on your financial goals, your risk tolerance, and your investment horizon. But regardless of these factors, the principle remains the same. Don't put all your eggs in one basket. Remember, diversification isn't just a strategy, it's a necessity. The more diversified your portfolio, the better equipped you'll be to weather the storms of the market. So, what are the secrets of the 2020 stock market that nobody tells you about? Let's recap what we've uncovered today. The stock market in 2020 was a roller coaster ride, and being prepared was the key to surviving the ups and downs. It's not just about having the money to invest, but also about understanding the market dynamics and being ready for the unexpected. Next, we delved into the power of information. Knowing what's happening in the market, understanding the trends and keeping an eye on the macroeconomic factors can give you an edge. But remember, it's not just about gathering information, but understanding and analyzing it wisely. We also touched on the role of emotions. Investing is not just a financial decision, it's an emotional one too. Keeping your emotions in check can prevent you from making hasty decisions. Finally, we highlighted the importance of diversification. Spreading your investments across different assets can reduce risk and increase potential returns. Now that you know the secrets, are you ready to conquer the stock market?